Hello class, welcome to our final piece of the depreciation narration and some extra explanation as well. So this will be part 3, and we're going to talk about real property, and we're really worried about these two: real estate, residential and non-residential, 27 and a half years and 39 years. This is long ago enough that there's not a lot of properties that are like that. So, real estate actually we'll find is the easiest part of the whole thing. Okay, here's some examples. Warehouses, office buildings are non-residential. This new convention, though, we learned about mid-year or half-year. We had mid-quarter. Now we have mid-month. And here's the thing to remember: real estate is always mid-month. Never mid-quarter. Never half-year. Always mid-month. No matter when you buy it, doesn't matter what percentage you buy in the particular time or anything like that. Now, all real property is mid-month. Okay, so it's always deemed bought and sold in the middle of the month, which it was bought and sold. So January, if it bought any day in January, we calculate depreciation as if it was bought on January 15th. Okay, so really you can never have a real property that was bought at the first of the year, per se, for a whole year. It has to be, if it's bought on January 1, it really is assumed to be bought on January 15th. So here's an example. Residential real property sells a property on August 4th, 2017. So she bought it a long time ago. And so in the last year, we have to assume the mid-month because that's part of the process. Once you get to the first year and the second and the last year is the only years you have to worry about mid-month. Everything else is just nice straight line, easy to calculate. Just the amount of costs divided by 27 and a half. But in this year, because he sold it, sold it on August 4th, so that's assumed to have happened on August 15th. So 7.5 months, January through July plus half of August. All right, for non-residential real estate, same thing, except 39 years and then different dates. So we go through June 15th. This is when they bought it, in this case. Okay, they started on June 15th, even though it was actually bought on June 10th. Okay, so 39 years. Home office is a non-residential real estate. Okay, and it's done on Form 8829. We talked about that in last chapter. All right, you can use an alternative 40 years for everything. I don't see that happening very often, property by property basis. Unlike in personal property, we have to choose a whole class and choose to use the ADS system. You can do it on each property one by one in real estate. So if you really wanted to spread out your depreciation over a longer period of time. Intangible property. Everything we've talked about so far has been tangible, meaning you can touch or feel it. First of all, it has to be purchased. You cannot create it. Self-created intangibles do not get deducted. Okay, so almost all intangibles that are purchased in the purchase of a business are amortized over 180 months or 15 years. Same, it's straight line method. Makes it easy. Okay, so there's some rules for more recent. Always, or Section 197, regardless of whether the purchase is part or acquired separately. All right. If they're not Section 197 intangibles, then you have to look at their useful life. So a 2-year covenant can compete contract is amortized over 24 months because it's 2 years. So that's how long it's going to last. Simple. The only one that's specified exactly is 36 months for off-the-shelf computer software. All right, again, it is straight line. Okay. All right, let's look at this spreadsheet real quick. Some examples. This is here for you to give you some extra example. This is how we calculate the half year. We're comparing the half year, the mid-quarter, and the mid-month convention, and how that would work based on a particular asset, when it was bought, and how you do that. First year was half year and mid-quarter. all right, and then mid-month. Little comparison between Section 179 and bonus depreciation to help you remember some of the principles. There are some advantages and disadvantages to both. Neither can be used for real estate. Section 179 can't be used for investment or rental. You obviously have a maximum. There's no maximum on the bonus. All right. And then calculation comparison on this last tab, showing how you depreciated each year, buying something in 2017 where you elected not to use bonus or Section 179, because you can choose to ignore both of them. Half year in the last year, half year in the first year. Bonus depreciation elected only 25, and then you take makers on the rest, and then finally if you took Section 179 all at once. Notice the total is the same, it's just a matter of which years you actually depreciate them. That's an important principle to remember. And then I want to spend a little more time than we did in the slides on Form 4562. We talked about this top part, Part 1, having to do with Section 179. But we didn't go down to Part 2 and 3. So Part 2 is where you would put special or bonus depreciation all together. So all lumped together. And then Part 3 is where you add assets. Notice this is assets placed in service during 2017. Only new assets. Okay? If you have assets you bought in past years that you're depreciating still, they all get added up and put on line 17. So notice, makers deductions for assets placed in service tax years beginning before 2017. This is only for new assets bought in 2017. You put them by class. 3-year, 5-year, 7-year, 10-year, 15. Most of everything's going to be 5 or 7. Residential real estate, non-residential real estate. Okay? And you're not, if you want to use the ADS system, you put them down here. You put the amount that you're going to calculate depreciation with. So if you took the bonus depreciation, you take first how much bonus depreciation, put it up here on line 14, and then the remaining amount that you're going to actually calculate depreciation on would go here as the basis. Recovery period, obviously if it's 5 years, it's 5 years. Convention, half year unless you're subject to the mid-quarter method, makers, and then how much the actual depreciation deduction is going to be in this final column. Okay. Remember, listed property is on the back side, page 2 of this. Then the total from the listed property comes over here to line 21. Okay, so 22 is addition of 21, okay, that came from listed property plus all of your depreciation deductions in this column, plus 17, plus 14. Okay, so it's like it's a total. Okay, again, the listed property. And a little bit about vehicles and stuff is also included because you have to show the IRS that you're using them for business purposes so they can challenge that. Finally, very bottom of page 2, amortization. So that last little section of our slides where we talked about intangibles. If you're amortizing something like that, then new ones go here. Old ones go on line 43. So that's how the Form 4562 works. The total depreciation then goes over onto either Form 1040 or 1065, 1120, one of those forms, to be reported as an expense. So that is the last of our explanation and ideas about depreciation.